Anyway, off you go
Okay.
with
Full pork
Resimac.
Resimac, RMC. So it's a non-bank mortgage lender. So what that means is that it doesn't take deposits. So in Australia, to be legally called a bank, you've got to get approval to take deposits, become an authorised depository. I think it's deposit receiving company. Anyway, you've got to be authorised to take deposits and follow all the rules and regulations for that. But this company doesn't, but it still lends, still loans mortgages and personal loans and business loans to people, which means that it tends to play in the part of the market where people can't get loans from the big banks for whatever reason, like they're a contractor or they're a small business owner or they're credit impaired. They've had some credit problems. So this company basically uses brokers to sell their mortgages. It also has an online business which it uses to also market their securities or their loans. And then what it does is it pools all the mortgage loans over a period, rolls them all up, gets them rated, and then puts out what's called a mortgage-backed securities, a bit like a bond to the market. So people who want a guaranteed income will go into the market and buy these securities, and they'll get a guaranteed coupon value from RMC, which will be less than what the mortgagee has to pay them for the mortgage loan that they've linked them. And then RMC takes the gap, the margin between those two numbers. So that's their business model, and I'll come back to it in a little while. The company's been around for a long time, and they claim they've issued $45 billion worth of mortgage-backed securities since 1987. They claim more than 50,000 customers and $13 billion in home loans at the moment. Uh, so, as I said, they lend to people who find it difficult to get loans from the major banks. They do, from time to time, actually also lend to compete with the major banks. That's called prime lending. But their bread and butter is the self-employed and the credit impaired. And they charge a higher rate to those customers to take into account the bigger chance of default. Uh, but they borrow for less than that in the mortgage-backed securities market, so they get a margin. They operate in New Zealand as well as Australia, and they also operate a couple of different brands. So Resimac's their main one, but they also have homeloans.com.au, which sells online. They also have an asset finance business offering business loans, car loans, personal loans, and equipment financing. So think of it being a bank in the traditional sense, but doesn't have deposits. Um, the securitization model, though, I think is interesting, and I should call it out because if we go back to GFC times, even though they're not issuing the type of CDOs, the collateralized debt obligation that caused the problems with the GFC, they are issuing something similar, which is to roll up mortgages, get them rated, and then issue them into that same sort of market. Not saying there's anything wrong with what they do. It's worked for them for a long time, so I have confidence in what they do. However, if that market dries up for whatever reason, um, because of something else that's going on, or there's another GFC Mark II in that market coming along, then they'll have difficulty raising funds to be able to issue mortgages. They did come through the GFC. They did come through COVID, so they do know how to handle these kinds of markets in difficult times. But their share prices did take a hit in both those kinds of both those times. So there will be issues for them. Getting to the numbers, the ADT for this stock is only $48,000, so it's not large. It'll suit people who have smaller portfolios. The price I'm doing the analysis at is $1.15, which is greater than consensus target. We don't often see that, but it is in this case. So scores a zero, or gets across for us on that, scores a zero. Yield on the company is rather good, 6.96, which is above the average for mortgages, so gets a pick for that. Interestingly enough, Stock Doctor financial health is unknown. So Stock Doctor, their financial health model can have difficulties with some kinds of finance companies, that, especially ones that operate in this kind of market, because it doesn't have the normal sort of business model that they're used to rating. It doesn't have a sort of coffee shop model, if you like. And I think that will become apparent when I go a bit further into the numbers. So can't score it for financial health. ROE is pretty good, 16.75. PE is kind of low, 6.98, but not the lowest, so we can't score it for that. Now, we get to operating cash flow. So the prop CAF that we calculate for this company is 0.23. So the price to operating cash flow is 0.23 times. But in this case, operating cash flow is a bit more like sales. So it's more like basically operating cash flow for this company is the income from loaning people mortgages, which is fine, which is only one side of the equation though, because of the financing cash flows has the coupons that they have to pay the people who take out these retail mortgage asset-backed securities. So PropCAF on an operating cash flow basis for the company is 0.23 times. But if I add back or I subtract the financing cash flows, the PropCAF goes up to 3 times. So it's still really low, but it just highlights that the sort of accounting standards for a company like this are a little bit different to a normal industrial type company. Price, as I said, was $1.15. It's greater than IV1, which is 85 cents, less than IV2, which is $1.21. So it scores 1 for that. And net equity per share is $1.04. So its share price is above that, but book plus 30 is $1.35. So share price is below that. So on our sort of heat map valuation, it's getting a 2 out of 4, which is not bad. Interestingly enough, the forecast growth for this company is minus 24% for EPS. So we're giving it a -1 for that. I'm sort of covering some of the risks now for this company now rather than at the end, but they did call out in their annual report that this year's been tough for them. 2023 has been tough for them for 2 reasons. One, because housing starts have been low, all the sort of COVID problems that we had with supply chain, etc., and the lack of immigrants for a couple of years there during COVID, slowed down the housing commencements, which means less mortgages, which has hurt this business. But also what's going on is there's been a mortgage war amongst the major banks in the last 12 months. And ever since the Hayne Royal Commission, the major banks are basically just mortgage banks now, or they take deposits, but they've all sold off their insurance businesses and their wealth management arms. And so they're left basically just with lending people money for housing, just some personal loans and credit cards, etc. But that's basically the bread and butter of Resimac. So I expect, that Resimac may face some stiffer competition. I don't know how long it'll be before these big, Goliaths in the market. I think Resimac has about a 450 million market cap, and what's Combank now over getting up towards 100 billion. So there's a huge disparity there. Might be 75 billion from memory. So one of 2 things is going to happen. Either the banks will progressively move up the risk ladder and say, okay, we'll start lending money to people who are self-employed or, haven't been able to get our prime tier loans. Or what may happen is one of the banks will just go, hey, let's not build, let's buy it. And they buy Resimac and bolt that on to their own business, subject to ACCC saying it's doesn't reduce competition in the market. But I think it's a watch this space, and I think it's fair to say that Resimac may get stiffer competition from the major banks going forward. Going through the numbers further, there's no owner founder. However, a guy called Duncan Saville owns 63.5% of the company. So, and I'm not sure whether it's him directly or through his fund. he chairs a company called ICM, which is a large fund manager. So as we've said before, with companies that have this situation, we still score them because there's someone on the board with huge investment experience, but it's not the owner founder. So it swings and roundabouts, I guess. I think it is beneficial to a company to have someone with this kind of skin in the game who is also, you know, really experienced at investing around the world. So I'm happy to have it as a 1 in the checklist for that. It's a new 3-point trend line upturn since the last result, so it scores for that. And it has been increasing equity consistently. And as I said before, that would probably cover, if not the COVID period, the immediate post-COVID period. And so it's good that the company can grow equity during those kinds of downtimes as well, even though people, even though it may have had problems with funding during that time. Anyway, all up, quality score is 67%. The QAV score is 2.92, which pops it on the top of our list. But if rather than use PropCAF, if I use operating cash flow less financing cash flow, it drops the score, the QAV score drops down to 0.22, which is still high on our list, but not the top of the list. So I'm just highlighting that to people, that sometimes, the PropCAF isn't the universal measure, and we need to just dig a bit deeper, but it still scores well for us. In terms of other risks, I spoke about the major banks. The mortgage war could continue. I mean, the mortgage war this year has been caused by two things. One, mainly because ANZ have been going after market share because they're still trying to convince the ACCC that they should buy the Suncorp banking arm. And their key argument is that the market will be equally competitive if they soak up Suncorp as it is now. So it's trying to prove that the big banks can be competitive, which has meant undercutting the rates in the market. But the second thing, which is also there, of course, is that people are coming off their 2% fixed loans taken out during COVID, and the banks have been fighting each other to rewrite those loans at higher rates. So it's been a very competitive market. Both of those two things will probably finish in 2024 if they haven't already. So the mortgage rates might normalise, or the mortgage market might normalise, but there's no necessary reason for that to happen. So Resimac may find stiff competition. And they called out in the annual report that they didn't write much in the way of prime loans last year because the banks were so competitive. But when the banks are fat and lazy and the market settles down, then Resimac do go into that prime market as well and compete with them. So that's going to be choppy for them. What else can I say? I think that's probably it. The business model, I think, is always going to have issues. Look, they've been managing it for a long time, and it's working for them. But should there be a tightening or a constraint in that asset-backed securities market, then that will crimp their ability to originate new mortgages, which will crimp their growth. The last point I made was that the forecast EPS negative growth of 24% I think it probably is already priced into the stock price. It's come down a lot in the last 12 months. And that might actually turn out to be fully priced at least, or we might see it get written back if the mortgage wars abate a bit. So it's, and I think the market's kind of working that out because the share price has gone for a run over the last month or so.